Markets are moving higher today following slightly better than expected or better than feared inflation numbers. But the question on everyone's mind is how long are markets going to continue to rally? And according to Citibank's Scott Schroner, the equity rally will run into trouble after the post-Trump bump. But more on that in just a moment. I do have to say there is growing complacency out there, it looks like, with the VIX again falling about 6% today. People are really taking off those hedges after Trump has won the election, and even after today's slightly good news. Like, it wasn't great news, it was slightly good news, and the VIX is down 6%. It does seem like a lot of the bears, as far as their positioning, they've started to throw in the towel and be less defensive, be less worried about where stocks currently are. Whenever you see people, or investors, I should say, that kind of all switch to one side, you do want to start paying attention. Now, that's not typically the ultimate peak. That's not when things immediately roll over, but the VIX now at 13.83 is getting close to that point where you have to say, are there enough bears out there? Like, people sound bearish, but they're actually not positioned bearish. Could you see a reversal? Of course, a reversal is possible at any time. Markets could fall. I do see the positives out there, and I think they outweigh the negatives, but you are getting more to a vulnerable point of a quick kind of, not correction, but consolidation to more level the playing field, if you will. It's really one of those things where, like COVID, for an example, markets were cratering because we all thought the economy was going to be shut down for months and there was going to be delinquencies, potentially a depression, right? And stocks reasonably fell on that. But once we realized it wasn't as bad as we thought it was, that, 30% of the population wasn't going to die, right? Then markets bounced back quickly from that. Well, the expectation had all grown consensus super negative, and it wasn't as bad as expected. Well, right now you're starting to get more of that and more of that consensus pointing towards everything's just fine. If you start to get some cracks in that thesis, it can leave you vulnerable for some quick downside. With that said, ladies and gentlemen, core CPI rose 0.28% in October. The 12-month rate held steady at 3.3%, and basically everything came in line with expectations. Besides that core month-over-month number that did come in a little bit light. The median forecast was 0.30%. Okay, so you were actually expecting core CPI month over month would come in a little bit hotter than it did. So it did surprise a little bit on the weak side. That's good news. Last month, core came in at 0.31% month over month. So this is a slight deceleration on a month over month basis, about 0.3 points, about 10% or so deceleration on a month over month basis. That's good, and that's what is likely fueling the upside in markets today. You can see from your banks, Barclays was expecting 0.30%, Goldman Sachs expecting 0.31%, Morgan Stanley expecting 0.30%, Namira was expecting 0.34%, TD Securities expecting 0.32%, UBS expecting 0.36%, underlying inflation expected at 0.32%, and Wells Fargo was at 0.28%. So all of these banks that I just mentioned, besides Wells Fargo, had their expectations higher than the number that we got today, right? So a vast majority of banks were overshooting their inflation, estimates for last month. So that is great news. That is causing the S&P to go up about 0.37% at the time of recording this video, and you are approaching a critically important level of 600 on the SPY or 6,000 on the SPX. If you do get a decisive break higher above that, which could happen tomorrow, it could really happen any day now, then that would likely fuel more of those animal spirits and send the markets higher. Now, some people ask, what is animal spirits? The best way to explain it is just optimism. It's just stocks going up because people are optimistic. That's what animal spirits mean, and that's kind of the point you're getting at now. If you see markets go up further, you're getting into those animal spirit-like territory. And no, it's not fundamentally based at that point, right? So I think a larger rally from here, it's really hard to make a fundamental case for the headline SPY because of the makeup you have of big tech in the market cap weighting of the SPY and the SPX. Big tech is extremely overvalued with median PEs almost 30, right? That's not exactly cheap for companies that aren't growing that fast. Apple has grown 5% in 3 years and it's trading at a 28 times multiple. Like, yeah, does that sound good? No. Is that good overall? No. I mean, those are some of the things that you can point to if you are a bear and say, yeah, that shouldn't be happening. You're overextended, right? Valuations are too high. But then when you look at the average stock in the S&P only trading at about 18 times next year's earnings, which is the historical average, the index internally doesn't look nearly as expensive as on face value. It's really just big tech that is skewing the numbers here. And I think if there is an area of vulnerability for markets, it will be within big tech, especially as you get close to NVIDIA earnings. NVIDIA earnings are likely going to have a larger outsized effect on these big tech stocks as well. Now, it is being reported today that AMD is laying off about 4% of their workforce. This is about 1,000 employees to realign their resources with the, quote, largest growth opportunities. Well, before you get NVIDIA earnings, AMD to announce 4% of their workforce is being laid off is not exactly comforting for Wall Street, and that's one reason why NVIDIA is down close to 0.5% today. It was also shared that SoftBank has been the first customer to take possession of Blackwell chips from NVIDIA. So a little bit of that, we were all anticipating Blackwell and the positives that would bring to NVIDIA, and now it's here. What's next, right? A little bit of a, buy the rumor, sell the news could also take place in the coming days. Now, Nick Timiraos is sharing with us 3 things that Lori Logan said, she is the Dallas Fed president today, that are the risks to the outlook in her opinion. She says, number 1, upside inflation risks from any combination of elevated demand or new adverse supply shocks. Number 2, demand risks to employment. She cites the potential for tighter financial conditions from the rise in long-term rates. She says, quote, some of that rise reflects expectations for a higher path of policy rates. And so far, higher equity valuations and tighter credit spreads have offset the tightening of financial conditions from higher treasury yields. But a substantial fraction of the increase in long-term yields appears to reflect a rise in term premiums. Term premiums compensate investors for bearing the risk of future interest rate fluctuations. Higher term premiums can tighten financial conditions for any given setting of monetary policy and thereby slow the economy more than the FOMC intends. If term premiums continue to rise, the FOMC may need less restrictive policy, all else equal, to accomplish its goals. So basically saying if market dynamics stay the way they are, the Fed could actually cut rates more than expected. Now, she says, number 3, neutral rates being higher than thought. I see substantial signs that the neutral rate has increased in recent years and some hints that it could be very close to where the Fed funds rate is now. Yikes. Quote, when policymakers look at mid-range estimates that suggest there's meaningful room to cut before reaching neutral, I think we should recall the technique of a ship captain whose depth finder might mistake mud for water. In these uncertain but potentially very shallow waters, I believe it's best to proceed with caution. So some of that sounded pretty good, but some of that sounded really bad at the same time, suggesting that potentially we are already at the neutral rate. Now take a listen to this warning from Citibank about equities potentially running into trouble here soon.
Of course, joining us here at Post 9, Citigroup Research Head of U.S. Equity Strategy, Scott Kroner. So Do you think that the stock rally is going to run into trouble here with rising bond yields and lower expectations for Fed cuts?
So the answer is we think yes. We completely understand we're getting this post-Trump bump, if you will, and we talked about this recently where we expected some follow-through, and ultimately we wanted to be prepared to lighten into that, Sarah. We sort of drew a line in the sand a few days ago saying at 6,100 is a level that we feel comfortable in terms of beginning to price in a lot of the euphoria that's surrounding a lot of the initiatives thus far.
So then how do you reposition after already the strong rally that we've already seen?
Well, I think the way we're thinking about it, it's a bit of a timing game, right? We're moving from a period of what we previously described as election uncertainty to now policy uncertainty. So we need a little bit more clarity on where we're going to see these initiatives around tariffs, taxes, or targeted taxes, or tax reform, and then deregulation. We need to get to a point where we see some meat on that so we can actually do some analysis. But right now, the issue we're contending with is that the starting point for all of this is a fairly valued S&P. We're north of 25 times now on trailing after last week's this past move. And interestingly, what we're contending with is an out-year earnings profile for the S&P that's still moving down. Okay, so in all told, what we're looking at here is a situation where forward valuations.
Why is it moving down? Sorry to interrupt. If growth expectations are moving up.
Well, because what happens is that this is very typical for this time of the year. You tend to see out-year numbers come down during the second half of the previous year. They don't normally bottom until you get into the Q4 reporting period, so first part of next year. So we've got that as an issue that we're going to contend with relative to the policy uncertainty, and then when you pull the Fed into it, you look at our normalized earnings yield gap analysis, and this is the most unfavorable for equities that we've seen over the past 20 years. So we have to recognize a number of moving influences here. All told, it leaves us, glass half full in terms of we're still constructive on the growth setup for most of the S&P next year, but a lot is being priced in ahead of that already.
Does that mean seasonality into February won't be as dramatic? Or, buybacks are still all-time highs year to date, right, on announcements?
Yep. Buybacks are looking really good. So longer term, when we think about the equity versus bond setup, comes back to where you are on rates. De-equitization for equities looks set to continue. You're going to see the stock of available stock come down, we think, over time, courtesy of repurchase. You can't say that for U.S. Treasury supply, most likely. Okay, right. So we do think that in aggregate, S&P equities are going to be in pretty good shape versus the Treasury setup. But all of that still comes back to it needs to be rational around fundamental expectations. And it's just very premature at this point to begin pricing in a lot of the potential that comes with some of these Trump policy initiatives.
Do you think that less political gridlock than we had in 2016 is better for growth or more dangerous on tariffs and sort of anything erratic, I suppose?
I think it's dangerous short term, constructive long term. I think we all want to see more efficient government. There's not much debate on that. But the issue is, we've been talking about this for the better part of a year now, things that keep us up at night, is that we've been living in this fiscal accommodation stimulus framework since we were in the throes of the pandemic lockdowns. And so that's been supportive, if you will, of a lot of the economic activity and fundamental traction.
This is Besant's whole point.
Yep.
That the Biden economy was about government spending.
Right. So if you come in and you start changing the impetus from fiscal accommodation to something a bit more restraining as you address some of these inefficiencies, well, there's a short-term ramification that you potentially lose some of that fundamental tailwind. Ultimately, it plays through from a longer-term perspective, but in the shorter term, it keeps this noise factor a little bit higher as we go into the first part of next year.
Which you really can't argue with what he's saying. It makes sense to be a little bit more defensive and a little on the bearish side from a more reasonable perspective, but markets are not acting reasonably. The real question is, do fundamentals catch up to the market's irrational behavior, or do we disappoint those expectations? And at that point, do the markets care about valuations? Because I will tell you right now, the markets don't care about valuations. Look at this. Normally, stocks track earnings growth, right? And you can see earnings growth here in yellow and the SPY in blue. Normally, these things go hand in hand. If the yellow line's going up, usually stocks are going up, and vice versa. Usually when earnings revisions are going down, stocks go down. That's not what happens right now, or it is what is happening right now. This did not happen in late 2019 as well. You're seeing earnings growth revisions to the downside, and stocks are moving higher. Of course, any rational investor would look at this and say, that's a bad sign. But what's to say earnings growth doesn't speed up from here? And then that kind of catches up to what the markets have already done. So who's leading and who's lagging here? Is the S&P just leading the earnings growth revisions, presumably to the upside that could be coming? Or is earnings growth downside revisions leading, or a indicator of equity downside? I think one of those things is going to happen, but it's hard to know which one is correct here. Now, as I've said here on this channel before, I do think we will get a correction. Yes, corrections of 10% or more do happen from time to time. They haven't seemed to happen as recently or frequently as they have in the past, but I do expect we will get a correction of 10% or more at some point in early 2025, when Wall Street starts to realize, oh crap, maybe the economy is not as great as we think it is. Barchar on X writes, the S&P 500 is now the most expensive since the dot-com bubble burst, based on cyclicality adjusted PE ratios. Probably fine. And they specifically point out here, when George W. Bush took office is when markets really started to fall. And I wouldn't be surprised if that happened again when Trump takes office. And that's more of the period in time that I'm a little bit more concerned about right now, is really January through April of 2025. Charlie on X writes, the S&P 500's CAPE ratio has crossed above 38 for the third time in history, and is now higher than 98% of historical valuations. The 3X leveraged long-term Treasury ETF is experiencing massive inflows, indicating that some investors believe Treasury yields are peaking. And that would be right on par with some of the bears' expectations that markets come down. Normally what happens is stocks and bonds inverse, and there's an inverse relationship between yields going up and bond prices, right? When yields go up, bond prices actually fall. So what normally happens when stocks do well is bond prices fall. That's hence the 60-40 portfolio tends to work over time, or historically it does, because when stocks are outperforming, bonds underperform. Well, when stocks underperform, bonds outperform. So that would mean bond yields ultimately coming down as the stock market also comes down. So anyone in that bearish camp, well, would be positioning for Treasury yields to in fact come down, not go higher. And Jesse Felder here on X as well says, on a price to sales basis, the stock market is very close to the record set in the post-COVID boom in 2021. On a price to book value basis, it's almost taken out the all-time high from the dot-com bubble in 2000. Mac10 on X writes that risk seeking is now at the 2007 extreme. Check out this rising wedge on the S&P 500. Consider the volatility that will be unleashed when it breaks. And I think this chart does make a great point. You're sitting at some of the lowest implied volatility periods you have seen since 2007. And when that happened, volatility went crazy, obviously, to the upside. Here on the day today, CNN's Fear and Greed Index is sitting at 69. Yesterday, you were at 68. So the Fear and Greed Index is continuing to move higher today, deeper in greed territory. Sentiment for the SPY today is neutral at 50. Yesterday it was bearish at 41. Message volume today is normal at 53. Yesterday it was normal at 49. And the participation ratio is normal at 54. And it is being reported today that Republicans are projected to win the House majority, securing a GOP sweep. So let me know what you think about all of this information down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.